All right, let's jump right in. We're going to be deconstructing one of the most watched stock indices on the entire planet, India's Nifty 50. We'll unpack what it is, how it moves, and how investors are trying to tap into its hidden rhythms to get an edge.
Just look at this line. What you're seeing here is a 20-year journey, the combined fortunes of India's 50 biggest companies. Kind of looks like a mountain range, right? But what this one single line represents? Wow, it's trillions of dollars in value, the economic hopes of a nation, and just a whole lot of drama. So, what is it really telling us? What's the story here about risk, about chaos, and about the hunt for opportunity?
Okay, before we get too deep, let's just nail down a key idea here. A stock index, like the Nifty 50, it's basically a market's playlist. That's a great way to think about it. It's this hand-picked list of stocks that when you put them all together, they give you a snapshot of how the whole market is doing. It's like taking a country's economic pulse, all boiled down into one single number you can follow. All right, so we know what an index is, but honestly, the really fascinating part is how it behaves. And that leads us straight to the market's hidden rhythm, a little something called volatility.
So check this out. We're looking at that same 20-year period, but this isn't the price anymore. This is the daily change. You could call it the market's heartbeat. And wow, it is so much more chaotic, isn't it? You see these periods where it's kind of quiet and then bam, these sudden violent spikes. That is volatility. It's the market's choppiness. It proves it's not some smooth ride to the top. It's this constant dance between calm and, total storm.
And here's the thing. This isn't just random noise. Researchers have looked at this, and they've pointed out that this volatility, it has a pattern. It exhibits clear signs of clustering. So what on earth does that mean? Well, it's pretty simple, actually. Stormy days tend to be followed by, you guessed it, more stormy days. And calm days are followed by more calm days. The big swings, they like to hang out together. So, and this is the crucial point, right? If it's not random, maybe, just maybe, it's predictable.
And this slide just illustrates that point perfectly. Those clusters of choppiness we were just looking at, they're not random at all. They're echoes of real-world history. Look here. See that huge spike? That's the 2008 global financial crisis sending shockwaves across the entire planet. And this one over here, that's the 2016 Indian demonetization, a huge domestic jolt with massive ripple effects. And then there's this one, the one that just dwarfs everything else. Yep, that's COVID-19 hitting in 2020. It's proof the market isn't in some vacuum. It feels everything that happens in the real world.
So that brings us to our next big question. If volatility isn't just random chaos, if it clusters up and reacts to real events, then the billion-dollar question for every analyst and investor out there has to be, can we actually forecast it?
The goal, really, is to create a kind of financial weather forecast. We're not trying to predict if the market's going to go up or down. Nope. The idea is to predict how turbulent the ride is going to be. Are we looking at a calm, sunny day, or are we about to head straight into a hurricane? And the tool they use for this? It's a pretty powerful statistical model called a Garch model. Yeah, it's a bit of a mouthful, I know, but the core idea behind it is actually pretty simple. It's a model built on one key assumption, that what happened in the market yesterday gives us some really important clues about the kind of risk we can expect today. And this isn't some fringe idea. We're talking about a Nobel Prize-winning concept that's become a cornerstone of modern finance. So how in the world does this thing work? Well, we can break down all the complex math into three pretty straightforward steps. First, the model looks at yesterday's surprise, basically the size of any unexpected price shock. A big jump up or a big drop down, that's going to carry more weight. Second, it factors in yesterday's turbulence. In other words, how chaotic was the market already? It kind of recognizes that volatility has its own inertia, its own momentum. And then third, it just combines that shock from yesterday with the turbulence that was already there, and out pops a forecast for today's expected risk. It's all about using the very recent past to get a glimpse of the very near future.
And this is what you get. What you're looking at is a 30-day volatility forecast for the Nifty 50, all generated by that Garch model. That line you see, that's the model's best guess for how risky or, how choppy the market is probably going to be for the next month. This is that financial weather report we were talking about, right here in action.
Okay, so we've been talking a lot about the Nifty 50, and yeah, it's the big one. But honestly, it's just the tip of the iceberg. There is a whole universe of indices out there, and each one tells its own unique story about the economy.
Just take a look at this. The market isn't one giant thing, right? So the National Stock Exchange of India has created all these different indices to track different slices of it. You've got your broad ones, like the Nifty 500, which gives you that big picture view. But you can also zoom way in. You've got thematic indices, like one for ESG, that let you track companies based on their social values. Then there are sectoral indices, like the Nifty Bank, which obviously just focuses on the banks. And this is super important for where we're going next. You have strategy indices. These aren't built around what a company is, but how its stock is behaving, like an index that just focuses on stocks with momentum.
Okay, so this is where it all starts to come together. How do we connect all these kind of abstract ideas, indices, volatility models, to the real world of actually investing your money? How do we go from the model to the money?
Well, it really boils down to two totally different ways of thinking, two competing philosophies. On one side, you've got passive indexing. The goal here couldn't be simpler. Just match the market. You buy a fund that holds all 50 stocks in the Nifty 50, and you just ride the wave. The whole philosophy is that the market is efficient and it's just really, really hard to beat. But on the other side, you have an active strategy. And the goal here is not to match the market, it's to beat it. The philosophy is that, hey, trends exist, and if you're clever about it, you can actually take advantage of them.
And that idea, that active strategy, it's really compelling, isn't it? So let's get specific. How does a momentum strategy actually work in the real world? So here's a great real-world example from a firm called Alphanity. What do? Well, they start with the whole universe of Nifty 50 stocks. Then, using this special combined score that looks at stuff like return consistency and performance over different time periods, they whittle that list of 50 all the way down to just the top 18 stocks. And then, every quarter, they reevaluate and update that portfolio. The goal is really simple, to always be holding the strongest, best-performing stocks from the main index.
I mean, just think about that number for a second. 18. Instead of owning all 50 companies just to match the market, this strategy says, nope, we're going to concentrate our bets on just the 18 stocks our model says have the most momentum right now. It's a really high-conviction approach, right? The whole idea is to capture the absolute best of the best.
So we've gone on this whole journey, right? From looking at a simple line on a chart, to understanding its hidden rhythm of volatility, to actually modeling that rhythm, and finally to building these active strategies that try to ride its waves. Which leaves us with one last really fascinating question to think about. If we can model risk and build strategies based on things like momentum, have we actually conquered the market? Or have we just gotten a whole lot better at describing its beautiful and sometimes very profitable madness?